Welcome back, and we're at the cusp of a very interesting conversation. We have with us Rajiv Batra, needs no introduction, Head of India, ASEAN and APAC, ex-Japan and China, Equity Strategy at JP Morgan, to give us his views. Rajiv, great having you here. I'm Harsh. Rajiv, let me start off by understanding from you. I know that one of your key tactical buys currently is PSU banks, at least within the Indian basket. And today, it's the one sector which is facing immense amounts of heat. And therefore, I want to probably quiz this as an opportunity for investors. Give us your sense. Why are you positive and tactically positive PSU banks? And what are the factors that you're looking out for which could play a spoil spot?
So definitely today market is going through or digesting the news that came off from MOF side that FDI limits may not be hiked, and market is digesting that. Prior to that, for the last 1 month or so, they were getting re-rated premised on this positive event that could have happened. So that air, you can say, is getting deflated out from the PSU bank story. But why we still remain overweight or positive on PSU banks? Because we think we are at an inflection point for the loan growth cycle for the Indian banking system. Beyond that, we are also looking into the expansion story, and most importantly, despite the recent rally and uptick, my entire financial space and particularly banks are still trading cheaper premised on their 5-year average valuations or even on a 10-year average valuation taking into account. And if we look into the three broad PSU banks and scheme, they are still taking huge amount of deposit share from the system overall. Their cost of capital is not very high, which is much more manageable. And along with that, if my loan growth is increasing, which mostly the credit growth data have recently shown, that will be music to the ears of my PSU banks also.
Okay, so in the medium term, do you expect a significant re-rating within the PSU banking pack, both in terms of ROA as well as in terms of price to book valuations? Is that something that you believe will happen, and maybe over the next 3 years?
No, definitely that will be the case. We also need to take into account the inclusion of much more technology in terms of a loan disbursement, customer satisfaction, the other check boxes which my PSU banks are doing, along with the tailwinds of the policy support, which is supporting your loan growth in the system overall. That will lead to not just earning growth coming into play, but sustainable earning growth is always followed by the valuation re-rating also. You also need to take into account the deregulation norms which RBI governor touched upon in October MPC. In that, one particular area of topic of discussion was M&A financing. So if my PSU banks start taking up share away from M&A financing pie, that will be another booster or kicker towards the loan growth for my PSU banks.
Rajiv, I know I've asked you a micro question to start off. Let me zoom out now a little bit. Try and get your sense on what are FIIs really thinking. And you obviously have a great visibility of in around India as well. What are FIIs thinking? What's the outlook like towards India? Because this money flowing out of India is pressuring the rupee, yes, but is pressuring, or rather is leaving a lid with regard to how the Nifty moves are playing out as well. So give us a sense on how you're thinking of this and what are FIIs really thinking?
So right now, my foreign investors, or you can say the whole investor community, is going through a volatility ride. That has started post Fed meeting in late October, where they made the December rate cut bet 50-50, and we have not seen ample amount of support came either in form of TOMOS or even in form of ease on the quantitative side in the month of November. And that followed up with the reactions which we have seen how Japanese bond yield market behaving. So taking all that factor into account, it's not just India is going through volatility, right? We can see across emerging markets and global equity space, like market is on the sideline. And most importantly, people have made seriously good amount of money, especially in the EM, North Asia, or the global benchmark, and it's giving them an excuse to go for a profit booking. But as I've said, like in the past, this 15 days of December are crucial. We are in a very policy heavy period where we have China CWC, we have RBI meeting this Friday, followed by Fed, then by BOJ. So expect this volatility to continue for some time. But yeah, foreign investors are willing to look beyond that. India being underweight for most of my foreign investor throughout this year, and India has lagged emerging markets, global equity market this year YTD by 18 to 20 odd %. And that is also worry for my foreign investors. Going into next year, if something has already underperformed and you are underweight, if the rebound rate comes and you are caught on the wrong foot, that's where they are getting a bit nervous whether they should continue with their underweight trade or they should change it to a neutral or even take an overweight stand. More so, they are worried because earning growth has made a comeback in India. Last quarter, we had 8 to 9% earning growth. The recent real GDP growth print was 8.2%, although I will say nominal GDP growth is still at 8.79% mark, not yet double-digit handle. But with growth making a comeback and huge policy tailwind, I will say from both the side, monetary and fiscal, and interestingly, even reforms like the labor market reform which government did is making my foreign investors who are totally ignoring India on a sideline, whether they should start revisiting. So I will say first quarter will be interesting to watch how capital flows or FPI flows played out in India when all my global fund managers start revisiting their model portfolios.
Okay. Now, Rajiv, I'm going to pause you there because what's playing out right now is we've got JFE Steel and JSW Steel, which are going to set up an integrated steel plant joint venture in India. Now, JFA Steel and JSW Steel are going to become partners. They've reached an agreement today, which is on the 3rd of December. They're going to invest 15,750 crore rupees, Indian rupees. And it's going to also be a transfer of the integrated steel facility of Bhushan Power and Steel within this JV. It's going to be a 50-50 JV between JFE and JSW Steel. JSW Steel, the stock reacting on the back of that, of this announcement that has come through. Now, Bhushan Power and Steel, which has been subject matter of plenty of controversy, now put to bed, and it's now the center of this entire transaction or this entire joint venture. BPSL, which is Bhushan Power and Steel, owns iron ore mines and an integrated steel works in eastern India. It has crude steel production capacity of around 4.5 million tons per year. Primary produces steel coils, sheets, bars, wire rods, and is a fairly competitive company in terms of production. And JSW Steel had taken it over, of course, and you had that Supreme Court ruling come through as a result of that takeover. Now that has been put to bed, and now what has happened is JFE wants to participate in this venture, and therefore they're going to set up a joint venture for that. You can see the intraday chart of JSW Steel and that reaction as a result of that. You've got a 15,750 crore investment coming through as a result of this, which is going to be an investment by JFE into the joint venture. It's going to be a 50-50 joint venture between both parties, likely valuing this Indian JV at around 31,500 crore, which is quite large, therefore. And despite that, we are seeing that stock not doing well, 3% lower now on a JSW Steel as a result of that. Okay, back to Rajiv. And Rajiv, we were speaking about how FDI has been, or FII investments flowing out of India has been a problem. And you've also suggested as to why that has happened. But talk to us about the levers that will change that. What do you think are the triggers that will lead to the reversal in flows, which will likely happen, and when will that likely happen in your opinion?
I'll say the number one trigger will be your growth. I have been saying on the record that due respect, foreign investors are growth tourists. They invest in the destination that offers them premium growth, or like what we are seeing in North Asia, a hope of a premium growth through AI. So if we can achieve either of them, either give them the actual one or give them the hope, they are going to come back into our region. India had an anemic earning growth of 4.5% for close to 5 to 6 quarters, due to which our PEG ratio in India, that is P to trailing P divided by forward earning growth, went into uninvestable zone for the entire year of 2024, 2025 in the range of 3x, 5.5x. So if growth makes a comeback and PEG ratio goes below the 2x kind of a mark, then yeah, India becomes investable, or India becomes interesting for my foreign investors all over again. That's number one. And second, the right chords which the policymakers are hitting. We are seeing twin policy easing action has happened. When the country was in a twin policy tightening mode, we never paid huge attention to it. The fruits of the twin policy tightening could be seen over the last 4 to 5 quarters in terms of growth decline. But now for the last 12 to 14 months, we are shifting into twin policy easing. Some of its fundamentals are already started showing up, be it the recent credit growth print or yesterday's auto sales data moving in high teen growth handle, or the agriculture sector growth. So it has started showing up. And interestingly, my policymakers are not taking a step behind. They're taking step forward in terms of factors reforms too. So labor market reform, where you are addressed 29 labor code into 4 over there, and that will increase, you can say, transparency, ease on the compliance, ease of doing business, will not just help you like attract more FDI flows, but also ease of doing business will happen at a mid cap, small cap, or even you can say the low rung business entrepreneurs also.
Okay. Rajiv, I'm going to again interrupt you. We need to take a very short commercial break, but we're going to come back and again continue this conversation with Rajiv Batra of JP Morgan. Stay with us. Welcome back, and we're in conversation with Rajiv Batra of JP Morgan. Rajiv, thanks for very patiently waiting by. Let me also get a sense from you as to this entire shift in terms of growth. Where do you sit in terms of India expectations now? Because the growth, of course, has accelerated. Can earnings momentum sustain? And for how long? What's your sense?
So it's a chicken and egg kind of a situation right now. We wanted nominal growth to come higher because my top line of most of the corporates' balance sheets are being dependent on what my nominal growth is going through. Real GDP growth has been great for India throughout this. But when we look at our JP Morgan economic team estimate, this fiscal year nominal GDP growth will be at a zone of around 7.7 or around 8%, which is one of the lowest nominal GDP growth we have seen in the last 14 years, except the pandemic period over there. So taking that into account, it is well and expected that you will see a slowdown in top line as well as in the bottom line for what has been going on for the past 5 to 6 quarters. But going into the next year, when we look at the nominal growth expectations, it is rising to 9.5% at a potential mark, with the chances that if the continuous tailwind of consumption increasing due to multiple factors, plus capex coming in from private sector in strategic sectors like semicon, data center, EV side keeps on happening over there, there's a potential we could get even to a double-digit nominal growth. So moving from current 7.78 mark towards double-digit kind of 10% nominal growth play overall will works quite well for earnings also, because historically we have seen whenever economic expansion is happening within emerging market, Indian corporates are very well placed and positioned to generate a higher earning growth out of that. So this is beyond your factors which we and other people on street keep on highlighting, that you have good monsoons, the GST cut, income tax cut. But the genesis lie if my nominal growth at the GDP level is improving, which should be the case for the next year, earning growth will tend to follow. So taking that into account, we are calling for second half of this fiscal year close to 13% earning growth, and for entire fiscal year 27, we are calling for 14% earning growth. It is marginally lower than consensus, but that takes into account kind of a hit some of the sectors will take due to AI, or even you can say on the pharma sector because one particular drug is going off patent. But beyond that, if we are able to hit 14 odd percent earning growth, it will be easier for India to justify its double digit absolute return for next year.
And Rajiv, the Smith space, you know, that pocket has been, there's been continuous commentary that that pocket has been a pocket where there have been overvaluations. Still trades at a premium. Do you believe time correction, price correction warranted, or that this earnings growth will disproportionately benefit them, and therefore you might still see some upside from here despite the premium?
So in terms of our allocation, we are like having neutral across the styles over there, large cap, mid cap, small cap. We like all three of them. We are not keeping a bet on large over or small at this juncture. And the reason behind this, as I've said, earnings is a very important lens. Why mid-cap trade at a premium? Just the reason past quarter, you had 29% earning growth for NSE mid-cap 100 stocks over there. And remember, this was the second consecutive quarter where you got 25% plus kind of an earning growth. So again, I'll go back to the similar metrics and framework which we watched, that is the PEG ratio. So if you look at the mid-cap sector forward PE, close to the range of around 30 odd or 32 or 35, and then you divide it up by your 25 or 29 or 20, even let's say earning growth, that still gives you a normal PEG ratio of less than 2 odd. So it is getting justified by earning growth. But let's suppose if any factors or cost factors changes, or any regulatory policy as anything that changes that start impacting my earning growth pictures for the mid cap, then that kind of a valuations will be difficult to justify. But for now, growth is well and able to justify the rally which we have seen in the mid-cap space, or a comeback, because on a YTD term, they are still not the huge performer to large caps yet. So they are either in line or marginally underperforming. But can they do well? Again, answer lies, can they sustain this kind of an earning growth for the coming quarters also?
Okay, Rajiv, we leave it at that. Thanks for coming in and speaking to us. That's, of course, Rajiv Batra of JP Morgan giving us his view with regard to how he's seeing the Indian market, as well as what to expect over the next 12 to 24